Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Here comes again the question. Now we're in tax season. We need to file our 2025 tax return. Is it too late to do anything about my tax situation? And you always see me talking about this. Proactive tax planning happens during the year. It doesn't happen after year end. Sometimes it's really too late to do anything about it since the year is already ended. However, we still have few things to be done. So if you are a medical practice owner, this is for you. This presentation is mainly focused on your needs and what you can do before filing your tax return for year 2025. So let me share my screen with you, and I'll usually start with the joke, and the joke is about the fairy tale of getting a tax return. Like putting the tax return under the pillow, and the fairy tale can replace it with large tax refund. All right, so what are the top 7 tax moves before you file your 2025 tax return? Why you need to do this now? Because again, April 15, 2026, as you probably know, is the deadline for most tax moves, as you're going to see. Extended deadlines for retirement plans through October. And there's the OBBBA changes that impact your 2025 return strategy and to avoid penalties and you maximize legitimate deduction. Okay, so the first move really is to max out your retirement contribution. We have talked about this in the last couple of videos. If you want to go back to them, we talked extensively about this. Your IRA or Roth IRA, you can contribute until April 15, 2026, so the deadline of filing your tax return, 7K or 8K if you're 50 and up. SEP IRA, if you have your business, you can have the extended deadline. So it's not only till April, it can be till September 15. When you file your business tax return, this is when you can contribute for your SEP IRA. So you still have time for this, which is great. 9 months. And the solo 401k, the employee deferrals has to happen by December 31st, but the employer can do by the time of the extension. So you can do, if you did part, you can still do the other by the extension time. Cash balance plan, we had a whole video about this one. It's not suitable for everyone, so you have to check if it can, if it's a good one for you, and it gives you the option to defer maybe 200K or even more if it was properly set up for your business. Okay, so first thing is maximizing your retirement contribution. Second thing is you fund your HSA. If you are eligible, if you are participating in a high deductible plan, if your plan is supporting HSA contribution, then you have till April 15, 2026 to make a contribution for tax calendar year, tax year 2025. And the limit is 4,300 if you are if you're having a self plan, or if it's a family plan, you have up to 8,550, and you have an additional $1,000 catch up if you are above the age. And the good thing about this is that it gives you triple tax advantage. It's a pre-tax in, so it gives you the deduction for any contribution you put in. It grow tax-free, and when you take it out for eligible medical expenses, it's also tax-free. So it's triple tax advantage that you have to make use of if you are not already. You need to be keeping the receipts, and if you're reimbursing yourself, you can do that anytime tax-free. So if you're paid out of your personal credit card, not from your HSA, you can reimburse yourself, but you just need to keep the receipts for any audit. All right, so that's the second move. Third move, clean up your entity structure issues. So this is when I need to, like when we always talk about separating your practice account from your personal account. If you haven't done this already, do it now. You need to document any loans, any shareholder loans, shareholder advances, equity contribution, You need to, especially if it's a C corp and you don't want to be subject to the double taxation, you need to structure this very well. So if you're having any issue with that, you need to document it very well. You need to keep track of it very well in order for you not to be subject to any issues. Reconcile retained earnings and the AAA for the S corps. You need to keep track of your basis. Okay, address any piercing the veil risks like related to formalities, minutes, resolutions, annual reports. Just get it up clean. You finish your bookkeeping. You need to be clean for tax season. Okay, capture every deduction. So you're a medical practice owner, you probably are paying for malpractice insurance, you have continuing medical education, you have your license that you pay for, you have a lot of expenses. Make sure you're capturing every single deduction. Home office. So if you work remotely, if you do like teledoc, or if you have an office where you do your notes, like if this is used regularly and exclusively for your work, then you have to consider deducting home office. Auto mileage. I have a lot of doctor clients who travel between multiple clinics or multiple jobs or have different 1099 jobs. This is all, you can take deduction for all the mileage. Just keep track. There is a lot of apps where you can do a mileage log, and you can take 70 cents per mile for 2025, and it goes up every year. So it's really, it adds up to great deduction. Your professional dues, journals, software subscriptions, capture every deduction. Keep track, save receipts, and make the best of your deductions. Okay, what else? Accelerate equipment purchases. Okay, so we this is really like a pre-year end of year deduction, because we said that now you can take 100% bonus depreciation. It became permanent, and you have the Section 179 expensing up to the 1.25 million. Well, this is the 2025 limit. So what you really need to do here before the year end, okay, you already bought the equipment, or you already yeah, you had it before year end. Now you just need to figure out what method would be better for you. Would you do the bonus depreciation or the 179? Because we said that there are different limits, and it may not have an impact at all whether you choose this or that. And but in some cases, when you've seen it, where it may have a difference. So you need to make sure that you're choosing the proper way of accelerating your depreciation. You capture your deduction for imaging, IT, furniture bought in 2025 to take full deduction for. If you have a real estate or real property improvements, you do cost segregation to get the most of the deductions. Okay, move number 6, review your estimated tax payments. So some people get like surprised, why do I have to pay a penalty? Because you haven't paid enough during the year. The IRS doesn't like you to pay them just when you file your tax return. It doesn't like you when you just pay at the end of the year. You need to calculate if you paid 90% of your 2025 taxes or 110% of last year taxes, 2024. If there is an underpayment, you need to file Form 2210, which calculates the penalty, and you need or pay before April 15. But that doesn't mean all the time that you need that you're not subject to penalty. But the sooner you pay, the less penalty you're subject to. So if you're filing an extension, you need to consider that as well. Use annualized income method if your income was uneven. So this is also another thing. So even if you didn't pay enough taxes during the year, but you had most of the income in the last quarter of the year, in the last month, then you should use the annualized income method in order for you to reduce the amount of penalty that you may be subject to. So if you find yourself having a big penalty, it may be recognizing that you have X amount of income income. But if it's not fair if you didn't have this income for the whole year. So why they're penalizing you for the whole year? It's not their fault. It's yours because you didn't calculate it right. So you need to use the annualized income method if your income was uneven during the year to reduce the penalty that is due. You set up your 2026 quarterly to avoid next year penalty. So we plan ahead for the next year. We learn from prior mistakes and we plan it right in the year we have in hand. Okay, move number 7, consider filing an extension. So Form 4868 extends your individual deadline to October 15. Form 7004 for business entities and due dates vary, depends on whether it's a corporation or S or partnership. But the thing that we need to know that extension to file does not mean extension to pay. Extension to file does not equal that. You have to pay by the deadline, either whether March 15, April 15, depends on your deadline. The extension give you time for if your return is complicated, if you're receiving a K1 from another partnership or from a passive activity that doesn't come before your deadline, and it gives you more room for strategic plannings. Like as we said with the SIP IRA, you have the deadline extended till the time you file the return. So you have, and instead of filing by March and having to fund the SIP IRA by March, extend it till September, and then you have till September to do the funding. So it helps sometimes with cash flow. Okay, so those are the 7 moves that I wanted to talk to you about. And the O3B bonus opportunity is the QBI deduction. They're now become permanent. So definitely a check on your 20% pass-through income deduction. The SOL cap, it raised from 10K to 40K through 2029. There are some phase outs, so you gotta check if you're eligible for it. Track your overtime premium, and I've seen this reported on W2s on box 14, where people have some overtime portion or overtime premium, and if you are an employer, you need to now report that to your employees that are receiving some overtime so that it wouldn't be subject to income tax. Okay, so your action checklist, schedule your CPA meeting as soon as possible, gather your receipts, 1099s, K1s, W2, make your final retirement contribution by the deadline, document all your business expenses and mileage, review entity structure and compensation strategy. If your entity needs to be, like if you need to elect an S Corp, you have till March 15 to do that for a new year, if it's not a new formed entity. So there are some deadlines to consider, depends on whether you're making changes to your entity structure or not. So definitely schedule a meeting if you have any questions, or if you need to maximize your 2025 return, if you think that you're going to be paying too much and you don't want to do the same thing in 2026. So now is the time to learn from our mistakes and not repeat it again. All right, so hope to hear from you soon, and if any questions, let me know. Thank you and see you next week.